the last class we stopped just in the very beginning, in the introduction of this. We stop here, right? And I told you very important national income accounts, because we are using macroeconomics and many of the macroeconomic variables to try to manage what is happening in our country. And therefore we have the national accounts, the national income account, and I explained you that you can try to measure your income, your output, your GDP, yeah, from the production side, that means the supply side, or from the demand side, yeah. The demand side is something where we will focus later. From the production side, okay, if you want to measure your output, your income, your GDP, you can do it just asking how much do you pay to factors of production. What are the factors of production? Land, capital, labor. In these examples, workers, wages, and capital, interest, and dividends. So try to measure that. Go and ask people, yeah, what are the payments, and then you will try to measure this output, to try to measure this GDP. The most typical way, when I told you that actually INEGI and all these institutes of the statistics in different countries are doing both, yeah, measuring the production side and measuring the demand side. The other case is asking people about purchases. And what this means, I have to ask households, families, about consumption, to ask about firms, companies, about investment, to ask the government about the spending of the government, and to ask to the rest of the world and my country about exports and imports, and try to measure net exports. That will be the key equation later. And then with these ideas, with these theoretical ideas that actually are coming from your minor case, we try to measure this concept that we mentioned many, many times, question in your exam, question in your quiz. What is GDP? Gross Domestic Product. And here there is a definition, yeah? Value of all final goods and services. Very important, final goods, yeah? Goods and services. Value, the market value, should be in the market value. If I'm talking about the current prices, the prices today, if I'm not removing the impact of inflation on these kind of goods and services, so I'm talking about nominal GDP. If I'm removing the impact of the inflation, then I'm talking about real GDP, or at constant prices. But it's very important talking about the market value of final, not intermediate, yeah, final goods and services, yeah, produced within a country, inside of my country. Doesn't matter who is producing this in my country, they should be producing inside of my country. Chinese people, Japanese people, Russian people, American people, whatever is working and producing something inside of my country, that is adding to my gross domestic product. For Americans, for many years, for many decades, they were not watching what is happening here. They were watching what is happening with the gross national product. Therefore, they try to measure what American citizens are producing in other countries. And what's very important for the US, for the rest of the world, usually we are watching what is happening here, gross domestic product. And just recently, Americans are also focusing here. They don't pay so much attention now to what American citizens are producing in other countries. Yeah, in a particular period of time. Today we are watching a video, or if we don't have time, so I will give you the link to the video. And in the video, these guys will explain that is after 1 year. Well, that is not the case. No, it's not compulsory after 1 year. However, most of the macroeconomic variables we are discussing is something that we can measure after 3 months, 6 months, or 1 year. And most of the times, to really know what is happening with these macroeconomic variables, it's necessary to wait 1 year to really know what is the value or something like that. We can observe the value of this one in 3 months, but actually something that could be changing later, because we had really troubles, yeah, when we try to measure something like this in practice, in reality. It's not so simple to try to measure something like that. And therefore, here in the definition is very important that it's in a period of time. You need to tell me what period of time. 1 quarter, 6 months, 1 year, 5 years, 10 years. Just tell me, explain me in what period of time actually you measure that. In the video, as I mentioned, they say 1 year. Most of the times we focus on what is happening in macroeconomic variables in 1 year, but it's not compulsory the case. So guys, this definition is something that you have to be reading later. You are looking for this kind of values for the homework, and we will mention more about this, yeah? Now I will repeat, gross domestic product equals the value of all final goods and services produced within a country over a particular period of time. Later we will say more about this one.
Production side of the economy. The production side of the economy transforms inputs, labor capital, into output GDP. Inputs equal factors of production, and payments to these factors equal factor payments.
Mm-hmm.
The relationship between inputs and outputs defined by the production function, y equals f times.
Let me help you. Y equals output. In practice, this is GDP. And GDP, output, income, is a function of what? It's a function of your labor and labor. Many times also we say it's population, yeah, depending how you measure in your labor. But it's a function of your labor and it's a function of your capital. What does mean? That is my labor and my capital, what explain my output. And here actually it should be a letter A. And A is representing technology, because technology is how I'm combining labor and capital, and given this knowledge, this technology, these ideas, that is what is explaining, that is what is determining my level or output. Please go ahead. Output is a... Antonio, can you go ahead?
Is a function of labor and capital, where the functional form can be defined in various ways.
Mm-hmm.
For example, corn equals F times land, labor, seed, and machines.
Okay, if I would like to go this, and that is the problem many times in business school, because people's thinking in my particular business, and here we're thinking at the macro level. So I don't care cornflakes by kilos. I care all the goods and services produced in my economy, and all goods and services produced in my economy depends on the amount of labor and capital and land, or the factors of production in my economy. But if you would like to think this at the individual level, something that we mentioned also in macroeconomics, so it depends on your inputs, and therefore you can see that the production of corn, for instance, just corn, yeah, in your country depends on what? Depends on land, the factor of production they need compulsory for something like that, labor, the seeds, the machines. So all the inputs here will explain how much you can produce or something like this. But at the macro level, for simplicity, let me tell you that there are only 3 factors of production: land, labor, and capital. And land is constant. The amount of natural resources in your country is something that will not be changing. Probably you know the amount of oil, petroleum in your country, or you don't know, but actually that's something that will not be changing, or the amount of gold or silver or other kind of natural resources. And therefore, let me assume this constant, and because it's constant, it's not affecting really how much you can produce. What is actually changing? Your labor and your capital. And what actually should be changing later, that we will focus, your technology. Okay, later, chapter number 3, we focus on this next week, I suppose, next class. Let me close this one.
Yes. Okay, yes. We use the terms output and income interchangeably in macroeconomics. Are they really equivalent? There are a few crucial distinctions between them. Capital wears down over time while it is being used in the production process. Net domestic product, GDP, depreciation.
Minus
depreciation. Mm-hmm. NDP is the total value of production minus the value of the amount of capital used up in producing that output. NDP is usually 87 to 89% of GDP.
Okay, guys, let me interrupt you, Feliciano. That will be my problem, and that happened to me before. It seems to me that the students who already know me, I mentioned that, because many times as economists, we're talking about something that we're understanding, or we're thinking that people is already understanding. When I mean output, when I mean income, because I'm assuming that people also have the same theory and the same kind of models, and it's people understanding. And it's something that you also can see in the newspapers that I'm asking you to read. Yeah, like the newspaper today, people's assuming that you know many things that they grow there in this kind of articles. Well, something that you just with experience, yeah, you will see actually when output equals income and when that is not the case. Yeah, because it's in my model, in practice actually it's GDP, and sometimes this is happening to me. Seems to me that it should be compulsory into question in your exam will be very clear, yeah? But when we're talking, sometimes I'm talking about output, income, GDP, as we're talking about something that is the same. Not compulsory the case, depends on the model, depends on the condition of your model, but many times we're doing something like this, yeah? Thinking that these are like synonymous. Then we know that it's not the case. I will try to make that point clear when that is necessary. And then, for instance, we're discussing here another concept that is very important and related. We're talking about gross domestic product, but you can be talking also about net domestic product, yeah? Net domestic product. What does it mean? Removing the impact of depreciation, yeah? You are measuring your production of goods and services, final goods and services, and so on, and you are forgetting that actually many of the goods and services that have been losing value because of depreciation. And therefore, you cannot be also talking about net domestic product, and you can be talking about net or many other kind of macroeconomic variables once you are removing the impact of these kind of things. For instance, depreciation. And you can see that compulsory, by definition, your net domestic product should be something smaller than the gross domestic product. Gross usually is greater than, must be greater than what is a net when you are discussing the same kind of values. Feliciano, please, in the point number 2.
Business by indirect taxes, i.e. taxes on sales, property, and production that must be subtracted from NDP before making factor payments. Factor payment, NDP minus indirect business taxes. Indirect business taxes account for more than 10% of the NDP. Factor payments are roughly 80% of US GDP. 3/4 of factor payments go to labor.
Okay. Let me go ahead, just mention quickly